I thought we would begin today's discussion with an investment class that is near and dear to practically every listener, and that, of course, is gold. Bob, according to the World Gold Council, jewelry demand still comprises nearly 70% of all gold transactions. Industrial demand only makes up about 14%. Investment demand only about 19%. Clearly, jewelry demand is by far the biggest piece of the gold demand puzzle. In fact, there's 3 times more jewelry demand than investment. If you took the entire global industrial demand, added to it the investment demand, it's still less than half of global jewelry demand for gold. Now, here's why I think that these statistics are so important. If we assume that jewelry demand remains steady, as well as industrial demand, that leaves only one major wild card. Investors purchase about 670 tons, or 21 million ounces of gold each year. But it's really just a drop in the bucket when you start to look at the dollar figures. That's about $21 billion of investment demand. It sounds like a lot of money, $21 billion. Do you care to guess what Google's market cap is for comparison, Bob?
But I'm sure it's much larger.
It is much larger. It's $153 billion. The entire annual investment demand for gold isn't enough to purchase 15 or so percent of Google's outstanding shares. There's also Cisco's $127 billion market cap. What about Microsoft with a monster $213 billion market cap? GE, $167 billion. But even this is small potatoes when we compare it with the Dow Jones Industrial's average total market cap. The Dow has a $3.34 trillion market capitalization. So all of the wealth tied up in just those 30 stocks of the Dow is enough to buy all the available gold 159 times over. Plus, there's another $1 trillion in the S&P 500 and another $500 billion in the NASDAQ. That comes out to roughly $5 trillion, enough money to buy the available investment gold 240 times over. What is the likelihood that $5 trillion of equity will suddenly shift into the gold market? Well, if you answered not very high, you're probably right. But if we assume that 1% does, that comes still to $50 billion. That's more than 2 times the current gold supply available for investment. So just using the back of an envelope here and a pen, if 1% of the stock market funds $50 billion, that is, flowed into the gold market, and that's only a $20 billion market, that's a 250% increase. And we know that the output can't change to meet that 250% increase, so price has to shift. If we extrapolate a bit further, since gold output, as I said, can't be doubled easily, then something in the equation has to change. Well, the basic laws of supply and demand dictate that equilibrium price must shift with such huge demand. Some of the funds will be directed, of course, into gold stocks and energy. So we'll round down to just a 2-fold increase in price. That's roughly $2,600 per ounce. Of course, that's a ridiculously conservative number. We're only assuming a 1% shift from stocks into gold. Let's change that number to 5% of stock investors who suddenly wake up and realize it's time to diversify into gold. Well, the math is simple. A 10-fold increase in the price of gold. That's $12,000 an ounce. Just a 5% shift. And that figure, I think, is still very conservative. Once the crowd wakes up to the opportunity in precious metals, the fuse will be lit. Gold fever could see 10, 20% or more of stock money flowing into gold. So let's take a more subdued stance, though, because folks are going to be out there thinking $12,000 an ounce, never going to happen in our lifetime. During the last bull market move, gold climbed from $35 an ounce to $850. That's a 24-fold increase. If we assume a similar shift this time around to predict the ultimate gold price, multiply by 24, $250 an ounce, the bottom of our bear market, $6,000 on the gold price target. If we take the average of $6,000 and $12,000, we're in the neighborhood of $9,000. But even then, projections, you can't always count on them. So I'm going to have to put my neck out here a bit and say at least $5,000 before this gold bull market is over.
And I think that you could very well be right. Procedure in 6 to 8 months. But a hard rock mine in a big open pit situation, it's anywhere between 3 and 8 years, depending upon where it is and and how it's structured, et cetera, et cetera. And so there's not going to be lots of gold coming to the market. It just isn't going to happen. And so there's, the fundamentals for gold are enormous. And if we didn't have GLD and SLV, there would be a lot more money going into the bullion market as well as shares as well. You know my trepidation about those two entities, and I won't recommend them because I don't think they've got what they say they've got in the way of gold and silver. And so there's a possibility that they're using fractional banking like the LBMA and COMEX are, and if one of them blows up, they'll all blow up.
Just to further corroborate your thoughts there on GLD, I spoke with Congressman Ron Paul yesterday. For folks that would like to hear those comments and discussion, you can do so in the second hour of this week's show. But he agrees with you. Jim Cramer had suggested selling gold stocks and purchasing the GLD. And Ron Paul said there was no chance he was selling any of his $1.5 million investment in gold stocks. He's not a big fan of GLD. I wanted to move on for a moment here and just take a brief look at an Armageddon-style scenario. We are assuming the dollar downtrend was curtailed and that we were only going to see 5% money flows out of the stock market. But many experts believe that we could see a dollar collapse in the next few years, not to mention many other global currencies as well. Now, under that Armageddon scenario, you could see a lot more than just 5 or 10% of the global money stock suddenly go rushing into an inflation safe haven. And suddenly you would see gold soar by, I believe, at least 20-fold from where we are currently, which would lead to a $25,000 per ounce possibility. That number actually climbs to $100,000, and I know that sounds a bit fantastic at first blush, but that's less than a 100-fold increase. Microsoft stock increased by 100-fold when we adjust for splits. That made legions of Microsoft millionaires. Suddenly, the delivery boy from the mailroom owned $1 million of Microsoft stock options. Okay, 7 figures. But the news gets even brighter for gold fans. While there were hundreds of .com IPO millionaires and Microsoft back in the late 1990s, there's only gold, silver, and a small gold stock market in comparison. In other words, investors' options are limited. So you might think of the internet stock revolution and then the $1 trillion running from equities as a giant funnel. That's what we could see pouring into the precious metals market. I'm talking about trying to drain the entire Hoover Dam through a garden hose. When the investor stampede begins in earnest, there will be no stopping the move. And instead of Google and Microsoft millionaires, suddenly there will be lucky gold and silver millionaires. Lastly, I'd like to dispel the myth circulating in the gold crowd that type of end-of-the-world Armageddon scenario is required to see gold north of $3,000 an ounce. The dollar does not have to crash. We do not need World War III for gold to soar. All that's required is a small fraction of the population to wake up to the big opportunity to protect their family's portfolio from market risk and volatility. A tiny shift of retirement funds, 401ks, IRAs into precious metals, and we are off to the races. The analysis I just presented shows that $5,000 gold is a very real possibility. And I think the time for trading precious metals has come to an end, and it is more likely time to build solid positions. At this point in the cycle, I think we're still only in the 4th or 5th inning of what could morph into a doubleheader.
I think all of the things you've said are correct. And people just don't have a clue to the leverage because it's been 30 years since the top out in 1980 in the gold and silver prices. Many people weren't even alive then. And so there are very few people still alive who went through that. I'm one of them. I think I'm one of the last ones. The leverage is enormous. The amount of stock available is just a pittance compared to, as you pointed out earlier, in other single issues, never mind a combination.